But anyway, very warm welcome to everybody. This is the tutorial number 8. We are near the end of our course, our term, our program, or your program, as it were. And I have a number of very interesting things I'd like to share with you today. Don't have any more batteries. Now, I like to just take a quick look at the quiz that was done on Friday. So that's about determining capital requirements, and then from there, your return on capital. Okay, I like to take a quick look at the so-called Lehman Brothers mini bond episode, which was a very, very sad, I think, traumatic chapter in the history of finance and also in Hong Kong banking. So not just Hong Kong, but Asia banking circles. I'll tell you a bit more about that in a moment. I'd like to discuss a little bit about index skew arbitrage. I think some of you were still wondering or not entirely understanding what that really is. Or you think you understand, but actually there's a lot more to it. I like to talk about correlation and correlation risks. I think Ryan showed you some funny looking graph. Students always end up asking us, what are those things and why do they look like that? So I'd like to spend some time discussing that. I can't use this. I don't have. Do you have little batteries? AAA? Oh, you do? Wow. Thank you. I'll give you back some new ones. Huh? No. Thank you. No, I will. So the one thing that I think is important that I want to say to you is that, so this is what the schedule will look like for the remaining part of this course. Today is May 27. We are right here, okay? And so Ryan will be here at 10 o'clock. We meet with him one more time next Sunday, but that is Sunday afternoon we meet with him. I can't remember where, but I'll let you know. So we do not have any more classes in Admiralty anymore, right? So you don't have to rush down there, and I don't either. On a Friday afternoon, and squeeze like a sardine in a can with another 3.5 million people. Now for the next tutorial, I'm gonna switch it back to Saturday, and we're gonna run 2 sessions, one at 10 a.m. You can see that here, one at 10 a.m. and one at 12:45. Now, if you belong to the presentation teams A, B, C, or D, then please come to the first one. But if you are from the other 4 teams, please come to the 12:45. Okay. Now, do you know what team you belong to? You do, because I sent you an email. Okay. So we will have each team speaking for around 15 minutes with some question time. Now, it is possible that so each team can take around 20 minutes, but I know these things always overrun. They always do. So it is quite possible that we are not able to have all 4 teams presenting. It is possible, in which case we might leave out one team at random. I don't know which one. And then one team at random from the other session, and then they can do it on Wednesday. Okay, that will be the last time we meet. Next week, we're not going to have a tutorial like this on a Sunday. I think I explained the reason. I think it is better that we are able to meet for the last time after Ryan has actually concluded all his lecture delivery, which is Sunday. So we meet him on June the 3rd, and then 3 days later, okay? So that way I can give you a better summary or briefing with respect to the exam, for example, okay? Is everyone okay on that? Yeah, okay. Now, these are so this is the schedule. So on the right-hand side, you can click on these links and you will see the replay of all of these tutorials. They're not meant to be substitutes so that you don't come. Anyway, if you come, then you get some points, as you know. And we meet. So I guess we meet after today. We meet 2 more times, but for me to talk to you about markets and credit and this and that, there is really just the remaining session. I strongly encourage you, if you have any questions you want to ask me, please take this opportunity. Okay, don't be shy. Even questions that are not related to the course, I'll try to help. You know, students write to me all the time. Even after they leave, they write to me. And sometimes they have a question. They are a bit shy to ask that in the office, which is fine. You don't have to be shy with your tutor or ex-tutor, okay? Now, let me just start with the quiz on Friday. Did you all get the right answer? That's a stupid question. You don't know what the right answer is, right? Yeah. Anchi, what answer? Do you remember what answer you? I think you gave the right answer. So 20%, 20. Okay. I think 20 around. All right. How about Lara? Do you remember what answer you gave on? All right. Okay. Now, the thing about this, I guess we can. It's quite loud. We can take one step back and look at this in a more sort of methodical manner. And let me just pull up the file. Now, as you know, even from way back in Basel I, the way the thinking behind capital requirement, and I mean, back then, you know, we're talking like 30, 40 years ago, things were banking was a lot simpler than now. But the thinking at the time was always that you have assets. We don't know what you have, okay? But of course, if you're running a bank, these are mostly fixed income type instruments. But even within that category, there's like there are sovereign bonds, there are government agencies, there are semi-government. An example of that, what is semi-government? An example of that would be, for example, China Development Bank, okay, CDB. Then there are corporate bonds, there are mortgages, car loans, there's securitized asset-backed securities, and all kinds of fixed income products under the rainbow. So a 10-year government bond and a 10-year corporate bond, okay, even though the cash flows might look similar, money is money, but the risks are very different. So they have to come up with a way to reweight the risks so that you are comparing apples with apples. And then these are called risk-weighted assets. Okay? And from there, and then they tell you how much capital. Okay, so your actual asset might be 100 million, but depending on what the risk weight is, it might count after the risk weight as 50 million, as an example. Okay, so this is before the risk weight. This is just a raw amount. This is after the risk weight. And then they tell you, the capital requirement, whatever X might be. If X was 8%, if it is, then the capital that you need to back up this asset will be 50 times 8, and so on. Okay. Now, this is actually this is a simple version of calculating how much capital that you need. Now, the problem with so they realize there is another problem. So if you are a bank and you are running a big bond trading book, so things are actually quite dynamic. So this is when assets are mostly held to maturity, which is fine. So it's fairly static and fairly boring. But when you are running a trading book, the bond might come in today and then it will disappear 1 week later. So it doesn't make as much sense when you are just holding something for 1 week, okay? Whether it's a bond or a stock or FX or commodity, when you're holding something just for 1 week, okay, you do have to look at the risk of that, I think, in a different way, even if it is a bond, okay, because it now the risk is more sort of market driven, if you like, okay. So that was the whole idea behind the slide from last time. Okay. Oh, by the way, there are new slides for today which I put online last. I did that as soon as I could. Okay. But Ryan gives you good value for money. Okay. There's a lot of stuff, but in lecture 10, okay, there are new slides. But I was gonna refer to lecture 9. And I think in here, okay, so now when you are trading something, then it's a little bit different. So the concepts here are shared, but in a different way. So what they do is, if you have a bond, whatever kind of bond it might be, okay, so they don't look at, oh, what is the principal outstanding? No, they don't do that. Okay, they look at what is the value at risk. You know what that means, right? The value at risk. Who can tell me what VAR is? That would be interview question number 1, I think. Can someone give me a very brief, very quick summary of what value at risk, what it means? Who knows that? Xin, do you know what is how would you explain value at risk to your grandfather? Hmm. Okay, so how do you determine that? Okay, there's okay. I'll try not to get too technical, but the way value at risk was a methodology invented, I think, mostly by J.P. Morgan back in the 1990s. What you do is you would look at, I think, mostly historical, okay, the price volatility of whatever investment you might have, and you would draw up a distribution. We like to think it's normal. It probably isn't, but never mind. Okay, so you draw a distribution. Now, as you know, the distribution, you have a mean and you have a sigma. Okay, and the value at risk is you tell your risk officer or the head of capital markets that, for example, I am 99% confident that this bond would not lose more than 3% in one day. Now, there are a lot of different ways to play it. So first of all, the confidence interval, I said 99%. It doesn't have to be, okay? It can be 99.9 if you want. And then the time interval, are you talking about not losing that amount in one day or 1 week or 1 month? Okay, so you need to define these. So there is some flexibility on this stuff. Okay, but the inputs are required. Okay, but what inputs you put in there is up to you. But you put different inputs, you get a different number. Okay, that's the thing. Now, if you look carefully at Ryan's notes, they actually do tell you somewhere that in the calculation of value at risk, typically, what are the so it's 99% and it's 10 days. That's what this means. Okay, if you put 99.9% and then 1 day, okay, the number will be different. Okay, if you put 99%, if you leave that constant, if you leave this constant, but you calculate the VAR for, let's say, 30 days, is that going to be a bigger number than 99% 10 days? You understand my question? Is it going to be bigger, or it will be bigger? Yeah, it should be bigger. So that's VAR, okay? And then they have another, okay, so let's get back here. So so first you calculate the VAR based on some fixed parameters, and then you get either a percentage or you get some actually dollar figure. Okay, so now you got the VAR. Well, fantastic. So what? Okay. Then the second step is there is a charge on the VAR. Now the VAR itself is not a charge, so the charge on the VAR. And with that, you actually multiply if the VAR was X, you just multiply X by 3.3. Now don't ask me why 3.3. I didn't come up with that. Okay, these are from the regulators. So that is a charge. It is sometimes called a capital charge on VAR, but I want to I'm trying to avoid using the word capital because it's going to get you confused. Anyway, it's a charge, and from there, you work out, you kind of work backwards. Okay, so this is my risk. This is the charge on my risk. Okay, and then they try to work backwards, and then they scale it up. not down now. So here you are scaling it down from 100 to 50. But here they take the VaR charge and they scale it back up to get the risk-weighted asset, and that is equal to the charge from step 2 multiplied by 12.5. Okay, so it is as if they think the charge is or should be equivalent to around 8% of the risk-weighted asset. That's another way to look at it, because 12.5 times 8 is 100, isn't it? Yeah. And now you have the risk-weighted asset, okay, and then you apply the capital requirement, which typically is 10%. And you can, in fact, you can find all these numbers in Ryan's notes. You can find the number 3.3, you can find the number 12.5, you can find the number 10, and I'll show you where they are. Okay. So these are now there's another thing called stressed VaR. You see why bankers have had a headache for 10 years because of all this stuff which never really existed before. So now they put a lot of requirements, and it's a lot harder to run a bank and be profitable. So here's but whether it's VaR or stress VaR or incremental risk charge or whatever, okay, these are just things that they add on to the requirement. But anyway, so here, okay, so that's 3.3 is when you take the VaR, you multiply by 3.3, and then you get the charge on that, and then you multiply by 12.5, and then you get the risk-weighted asset, and then you apply the capital requirement. That number appears earlier, I think. Here we are. Here. Okay. So sometimes these are jumbled up. So I'm trying to reinterpret it for you. Okay. Now, I think it's probably easier if we actually go and have a look at the quiz. I'm trying to do that for you, with you. So I put that as the last page of the lecture scripts. This is also online, okay, as you know. The notes that Ryan makes, I put them up in Blackboard also. All right, so this was the quiz. And so what you do, you want to work out the return on equity. But first of all, if you want to work out the return on equity, well, there's the return and there's the equity. Okay, the return you already know because they tell you it's 30 basis points. So you don't have to worry about that. But what is the equity requirement? Well, it is exactly what I just said. Okay, so the VaR is 100K. Now there is a charge on the VaR. So you multiply that by 3.3, that becomes the charge, sometimes called a capital charge, okay? There is a charge on the stress VaR. A lot of things to add. This is to cater for any, real contingent extreme scenarios that are not normally covered just by normal market circumstance. So that is 200K, okay? times 3.3. And then there is this thing called the incremental risk charge. Maybe you're wondering what the hell is that? Well, actually, if you just look at the notes, it's explained here what it is. Okay, it's just another thing that they put on. The point being, oops. So I will not explain what that is here. I'll just show you the calculation. So the incremental risk charge is 180K. Now this one is already a charge, so you don't have to scale it up by 3.3. But what you need to do to all of them, actually is to multiply by 12.5. Okay, in order to get the risk-weighted capital. So you do that, that becomes, and then after you, so return on equity is actually the return divided by the risk-weighted asset multiplied by the capital requirement, okay? And in this case, it is actually, it's 10%. All right. So if you were to do all that, well, actually we can't do it. Okay. Just take me a little while. Maybe it's faster on a spreadsheet. So I feel it's important to kind of go through it with you, because this might come up with the exam. I don't know, and it wouldn't be so simple, okay, but it would be something like that. So the VAR was 100K, wasn't it? Yeah, and then the stress VAR is 200K, and there is the incremental risk charge, which is 180. So so these are the amounts, and then the charge on that would be this one times 3.3. Same for the stress VAR. Okay, the IRC already is a charge, so you don't have to scale that up. So the risk-weighted assets would be equal to these numbers multiplied by 12.5. Okay, so this is the total requirement in terms of RWA is this number here. Okay, that's the total, and then so the required capital is just this number multiplied by 10%. So that's how much capital you need to back it up. Okay. Now, what is your profit? You see, we only look at that at the last part. That is a simple one. Okay. All the time we're so busy calculating what are the costs, and then we look at the profit. The profit was 300. Hold on a second. This is 100K, right? 200K, 180K. The profit is 300K. Sorry, these are all in thousands. Okay. So the ROE would just be this one divided by this, which is 20.5%. So if you got that, you got it right. Okay? Everyone is okay with that? All right, so that's the quiz for Friday. All right. Yeah.
So maybe other kind of alternative products will have different kind of capital requirement. So is there a table to show the different kind of capital requirement for them?
To be honest, I don't know for sure, but I suspect not. And I suspect not because when you convert all the different kinds of risks of different asset classes into VaR, you are trying to compare apples with apples. I think. Okay, so if you further differentiate, oh, this is an equity VaR, or that is a fixed income VaR, then I think it rather defeats the purpose. I suspect not, but I don't know for sure. Maybe you can ask Ryan. He's the expert. I can show you something, which is I have a report which is from Morgan Stanley. Now, what is the name of this report? Although it's actually a little dated, it's okay. It says Market Risk Capital Disclosure Report, Morgan Stanley, end of March 2013. Now, in here, you can see, now this table is interesting. So can you actually see that? So components of market risk capital charge and risk-weighted assets. This is precisely what we have been talking about. And if you can see the categories, so there's a regulatory VaR. There is just one VaR number, which is 887. So it's not split into, and I'm sure they have all kinds of products and trades going on with all asset classes. But there's just one VaR number there. There's a stress VaR. So all these things are there. The IRC. So this is real finance. These things, they really are using it. If you care to examine the relationship between the number, now here it says capital charge, okay, 1626. If you multiply that by 12.5, what's 1626 multiplied by 1626 times 12.5? It's 20,325. There's some rounding, don't worry about that, okay? So it's actually, so when you multiply these numbers by 12.5, it gets very, very close to the RWA, okay? And then there are all these other charges. So I think the idea is whatever other, it's like going to an expensive restaurant in a hotel with all these charges, this charge, that charge, okay? Securitization charge, correlation surcharge, oh my God, what is that? Standardized charges. It's now very expensive to run a banking operation. So you have all these charges, and mostly I think you just jack it up 12.5 times. It's another way of saying that your charges will be 8% of whatever risk-weighted asset amounts you end up with. Okay, you get my point? Yeah. So that is how that works. Okay. To summarize. So first you determine the VaR and the stress VaR and incremental risk charge and this and that. And then you determine the charges that are connected with them. for that, you multiply by 3.3, at least for these ones above, okay? Except the IRC, you don't need to jack that up, okay? And then you determine what are the risk-weighted asset equivalent. It's actually very simple. You can knock out a spreadsheet in 5 minutes. We just did, okay? And then the capital requirement, typically it is 10%. It was 12.5 earlier. And then now you look at how much money you are planning to make. Okay? So you can see immediately that when you are looking to do a deal, okay, in the old days, wow, I'm going to make 300K, go for it. Okay, it's not like that anymore. Maybe it never was like that, but now it's even less. So you have to look at what kind of return you are making. Yeah. You divide one by the other. That's it. Is everyone okay? Yeah? All right. For the purpose of this exercise, actually the no, you don't need the cost of capital here because let me just go back to for the purpose of this exercise, you need to just work out what is the return on capital, okay? The return on equity, Lara, and the cost of equity are quite different things, okay? Now, your return can be 20%. Your cost can be 25. Now, we are not discussing the cost here. Now, what does the cost of 25 mean? What does that mean? That means because of the risks of your company, okay, investors, they expect you to make 25%. But for this exercise, we are not actually discussing this. We're not discussing the cost. Of course, a relevant point is that if your return cannot even beat the cost, okay, then there's no point doing this. Okay, but we are here just determining what the return is. Are you with me there? It's okay? Yeah. Yeah. So don't confuse the two. It's a good question. Okay, it's a good question. Okay, now, if you're all right with that, I want to just, I think some of you guys were still a little bit sort of unclear regarding the so-called mini bonds that was but not only that, because in there, embedded in there, is a very interesting structure that for a long time, investors, the retail investors really did not understand. And I want to bring it up here because you will learn a lot from this interesting episode. Now, this I guess, around maybe 2003. So between 2003 and 2008, those 5 years, if you look at interest rates globally, they were very, very low, and they stayed low for quite a while. So for quite some time, there was the combination of a very quiet and uneventful market globally, combined with fairly low interest rates, combined with rather loose regulations. So you have a very volatile mixture of all three. And I think the mini bond was really a result, partly, of all those factors. Okay, low interest rates, rather boring markets globally, low returns, and then loose regulations. So what they did was they packaged, strictly speaking, these are structured credit products, and then they sold that to the retail public in Hong Kong through a series of banking networks, including, for example, Bank of China was a big one. Okay, they took a lot of heat from that Bank of China Hong Kong, including Standard Chartered, Hang Seng Bank, DBS, and a series of local banks. I don't think HSBC was ever involved in a big way, as I recall. Okay, so they kind of escaped. But the other ones that I mentioned, they were all in it. So they were selling these to customers on the street, and mis-selling them, as it were, unfortunately. And the way these things, the way they work, I have a diagram here, but it's not really the best one. But the way they work is there is an investor on the street, your uncles and aunties, mommy and daddies, and then they would buy from the issuer, which typically is some kind of special purpose vehicle. Okay, it wasn't Lehman Brothers itself, and then the issuer. So they would pay some money to the issuer, and as you know, whenever the issuer receives the funds, they have to turn around and they have to invest it somewhere. Now this is called the funding part, as you know, and this applies no matter what you do. Okay, if you were in a bank, if the bank was an issuer, then typically they would give it to the money market desk. Okay, and then the money market desk will in turn place it in the interbank money market, sometimes known as the STMM or short-term money market. So they would give it to like HSBC or Deutsche Bank or Barclays, all these high-grade, high-quality, large-scale commercial bank. That's how it's supposed to work. Okay, they didn't do that, and I'll come to that in a moment. That's what you are supposed to do. Okay, but anyway, the other thing that they needed to do was to go to the credit derivative market. Okay, and they sold protection. They sold what's called first to default protection. Now, this product, or first to default basket, this product is still being traded actively, okay, and for that, you receive a fee, which is X. And here, so when you should get either LIBOR or a fixed or some kind of a fixed rate. Let's just say a fixed rate. Let's just say 3%. Okay, and here let's say X is another 3.5%. Let's just say it is. Okay, so total you've got 6.5% coming in, 3%, and they may well give the investor 5%. Let's just say 5. All right. So that's how it works. Please do try to understand how this works. I think it might even come up with in the exam, but that's not really the point. Whether it comes up in the exam, as a finance professional, you should know what a first to default basket actually means. Do you understand what it is? Do you want me to go through it? No? Yes? Yeah. Now, the FTD, the first to default basket, actually is quite interesting. I find the concept very interesting. First to default. So typically, when you buy, let's say you invest $100 and you buy a first to default, these will be called first to default basket notes. And Ryan is really the expert on that. Okay. I've traded some of these, but not so many. So what they will have in there are a list of names, and it's normally between 4 to 7 names. For example, the name can be Boeing, okay, and then Microsoft, let's say, and then maybe Alibaba. Anything you want, okay? It could be China Mobile. I'll think of one more. Let's say Amazon. Okay, so the idea is, and let's say it's a 5-year trade, 5-year, okay, and then you get a coupon, which will be substantially higher than what you would get for just any one of these names. So let's say for any one of these, you get 3.5%. Let's just say, okay, I mean, let's keep it real simple. I know they will all be different, but let's just say 3.5. Now, if you take a risk on all 5, you're not going to get 15% or 17.5%. That's not going to happen. Okay, but you might get something which is a little higher. So maybe 6.5 or something. I'm just making it up. Whether it's higher than that or lower than that depends critically on the correlation. So this is a heavily correlation-driven product. So it depends on the correlation between these names. So you get a bigger coupon. Now, what is your risk? Your risk is that if one of these default, then you will lose, potentially you can lose maximum $100. Or if there is some recovery value, then you just lose whatever is the defaulted amount. Okay, so you might lose $60. The interesting thing about something like this is your risk has increased, of course, because you are taking risk on 5 names. But so you think, okay, there must be leverage in there. Okay, there is leverage in there. Okay, but is not leverage in the conventional classical sense that we understand. For example, if you do, let's say, margin trading on stocks, okay, now that's a very, very simple way of understanding leverage. You put down $20 and you buy stocks which is worth 100, okay, so you're 5 times leverage, but guess what? When you do that, you really potentially can lose 5 times more than what you put in. Here you won't, okay? Here you put in 100, your worst case is 100. So where's the leverage? The leverage is you have increased your risk of getting a loss, okay? Now, so the thing is, if all 5 names simultaneously defaulted, let's say if that was to happen, okay, you're not going to lose $500, okay? You still only lose 100. So that is the beauty of it. So you are leveraging, so you increase your risk, but you do not increase your worst case is still a loss of 100. Okay, so that's something to keep in mind, which I think is quite interesting. It is different from the really simple leverage that we understand. That's number one. Okay, so that's called a first to default basket. There are even like varieties. I have seen things like they are called second to default. Okay, so you buy a note. So there are 5 names, and if one of them defaults, you don't get hit. But if a second one comes along, and also if that one sinks, then you will suffer a loss. So obviously the risk is smaller, okay, but your return also will be smaller. So all kinds of variety. Is everyone okay with that? Yeah. Correct. That is why it's called FTD. It's always the first one. So as an investor, you don't really care what happens after the first one goes. Okay? You just hope that never happens. I ask you a simple question. If you are an investor and you're looking at buying one of these, do you want to have a diversified basket? This basket is pretty diversified. Or do you want to have a basket where all the names are pretty much, what's the word, homogeneous, like all banks or all airlines or all IT? Which one would you prefer? In terms of risk, which one do you think? Or if I pay you the same coupon, let's say, I pay you the same coupon, do you want a more diversified basket, or do you want a more homogeneous basket? Same coupon. That's easy to compare. Which one do you prefer? Homogeneous. Why? Very good. Sorry, I'm just making note on the participation. Somebody else asked a question just now. Who was it? You are Jing Yi, right? Yeah. Okay. I'm starting to remember all your names, and it's time for us to say goodbye. What was the question? What were we talking about? Oh, yeah, homogeneous. Yeah, that is correct. That is the right answer. Okay. The reason being, if you are more diversified, take an extreme case. You have a portfolio where things are actually not only diversified, but they are inversely correlated. Okay. So that means when something does very well, you can guarantee that something else is going down the toilet. Then that means there is always there's a much higher likelihood that something will go wrong, and then you are much more likely to be hit by default. Now, this is why I find finance quite fascinating. You learn from Professor Fong that diversification is good. Well, this product has actually turned that idea upside down. Diversification here is bad for you. I have heard, sometimes naive investors, they buy one of these and then they go around and they tell their friends and they say, wow, I bought this first to default basket and it pays a really big coupon of 7%. And I get a really diversified portfolio. I love it, okay? And so our job here is not just to teach you finance and to help you find a job, but to protect you, from other okay, so that's the first to default. Now the story doesn't end there. So the problem, the other thing, and I think Ryan was trying to highlight that point on Friday night, was that, so this is the basket, and the other part, which is here. Now, you are supposed to put that money away somewhere safe. Now, what does that mean? The safest would be you go and buy treasuries, for example. Okay, but then if you buy treasuries, you probably end up getting like 2%. Or you can put it in the interbank market. You park your cash away somewhere with banks like Citibank or UBS, HSBC, JP Morgan, Bank of China, okay? They are not risk-free, but at least they are higher quality, okay? Now, in the case of Lehman, they didn't even do that, okay? They didn't park the money like well-behaved money market participants. They went and they bought high yield, okay? So they earn even more money. They didn't put it in the interbank. They went and they bought high yield assets. So that might have given them, let's say, 5%. Now, of course, investors don't know that. Investors don't know. They probably didn't care either, okay? Or they didn't know. It wasn't. I think there might be a little footnote at the bottom of page 65 saying that we might take your money and potentially reinvest it somewhere else to earn a higher funding, something like that. Okay. So when Lehman collapsed, the whole thing just unraveled like a house of cards. And there was a lot of grievance, not just in Hong Kong, okay, so elsewhere in Asia, in Taiwan, in Singapore. Okay, I know a lot of friends who lost money as a result. A lot of these were retail investors, mums and dads, and retirement and pension money. Now, you can argue until sunrise as to who is at fault. I think there was certainly some mis-selling. So the banks were telling, these retail naive investors, oh, you buy something like this, it's just like a deposit. Just like a deposit. That's a very dangerous statement to make. Well, because end up it wasn't like a deposit. End up the whole thing just went upside down. Okay. The reason I thought to mention this, you might think that, well, this happened like 10 years ago. It's got nothing to do with me. Okay. Far from it. I think you need to understand very well what happened in the past. It's a bit like if you are a doctor and a new patient comes to you, or if you're a junior doctor and you take over a case, you absolutely have to understand the medical history of the patient. Otherwise, you can't treat them. Okay, there's no way you can do it. It's technically not possible. So this is a bit like that. If you look at the regulations in Hong Kong now on investments, a lot of the things, including all the risk disclosure and signing off on your risk appetite, including when you walk into a bank, there are two different sections. There's the normal banking section, and then there's the wealth management zone, okay? And then when you do a trade like that, now there is a audio recording. All of those things are a legacy of this unfortunate incident. So there was a time, and you can still see that if you go to Google, if you type there was a time, but not anymore, in Central, when every single day it looked like this. Okay, you see these pictures, and I think when you just look at the photographs, you kind of get the message. Okay, so shame on SFC, that's the Securities and Futures Exchange. Banks are crooks and this and that. Okay, so a lot of these things. I don't mind telling you, by the way, that a lot of these protests outside banks for a long time. This is not like just 1 day, 2 day, one week, 2 weeks. This went on for years. Okay. I want to tell you something which was equally interesting, but less well known. And that was, so Lehman Brothers, they were the pioneer in issuing this type of instruments, but they were not the only one. Okay, another entity which was also quite active was Morgan Stanley. Okay, and there was a story which was even more interesting, but it's sometimes overlooked. Now, what went wrong there was, so Morgan Stanley did something similar to this. Okay, they set up an SPV, they take money, then they turn around, they park the money away somewhere, and then they traded the FTT baskets. In the case of Morgan Stanley, what was interesting was that, so they had these names. Okay, the names could be, well, like I said, it could be, let's say, Boeing. Okay, it could be PetroChina, whatever you want. Okay, it could be Cathay Pacific. Now, and then they also invested the money in high yield. And in the case of Morgan Stanley, the notes that they issued at the height of the credit crisis, the interesting thing was these names, they never defaulted. So these were reasonable or okay names. Okay, so the bonds were, I mean, everyone was under stress, including these companies, but they never defaulted. But the high yield that they bought, these actually defaulted. And that became a mess because now investors are confused. Now, these are retail investors. If they buy the Lehman, at least they understand something happened. Okay? If you are a retail investor and you buy one of these pieces from Morgan Stanley through, let's say, DBS, okay, so they were selling them via retail bank channels. You go to DBS and you ask them, hey, I just received my statement, and now it's telling me that this note I bought from Morgan Stanley is only worth 30%. What the hell happened? What is the guy going to say? Oh, we actually took your money and we parked it away in a special purpose vehicle in the Cayman Islands, and then we turned around and then we invested that in high yield collateral, and then one of the names, unfortunately, has had a credit event. So as a result, your investment suffered from a massive mark-to-market loss. How is a guy going to react? How is a retail investor going to react? I tell you how they'll react. Huh? That's the reaction. You know what I'm saying? So they lost money and they couldn't understand why. Okay, so that was something else. Okay, so all quite interesting. I've got some notes here. Well, I think I will not go through it, but it's essentially repeating what I just said mostly. Okay. Yeah, so there was a lot of blame to go around, a lot of protests. It's mainly because politically it was such a sensitive issue. So the investors, they went to the politicians, and the politicians went to the government. The government went to the regulators, Monetary Authority or SFC, not SFA. And then the regulators went to the banks, and the banks had nowhere to go, so they paid up. Okay, I say they went into navel gazing mode. Do you know what is a navel gazing mode? You know what gazing is? Gazing is just look at something. You know what navel is? Navel is your belly button. How you say it in Chinese? So navel gazing means you just do this. That's what banks do, okay? They don't know what else to do because they're the last one in the tail. Okay? And they pay the investors in the end. Okay, I want to see if I can. It's now 9:45. I can tell you just quickly regarding index skew arbitrage. I think this is something that Ryan mentioned earlier on in the course. Now, what this is, in essence, one more note regarding these structured credit notes and issue with SPVs. I remember one of you were asking, nowadays, when you have an SPV, these days, when you give money to that SPV, quite often the investor would require the SPV or the sponsor to make very, very clear disclosure. Where are you going to put your money? And sometimes they explicitly require that the money be used to buy U.S. Treasury. This is the reason. Okay, the reason is they don't trust the banks to put the money somewhere properly. So at least we have learned a lesson from that. Okay, so that is the reason why. Okay. Now on index arbitrage, so I think the idea itself really is very simple. So out there, you have in the CDS market, the credit default swap market, there are a lot of quotations. So practically any company which has active bonds trading, or even some of them that don't, they would have a CDS bid and offer quoted. So maybe you have Bank of China, and then there's JP Morgan, and then there's Alibaba, okay, and there's Amazon, there's Apple, and so on. Okay, so all of these, there would be a CDS level, 125, 140, maybe 170, okay, 250, whatever it might be, okay. And then what people end up doing was they create these indices. Now, if you have a bar, and you can create any kind of index, you can create an index on European sovereigns, an index on the automobile industry, index on tech, index on banks, index on retail companies or telecom, whatever, okay? And then you literally add up all these numbers, and your index value would be the total of all these. Okay, whatever the total might be. Now, the interesting thing is these indices themselves are tradable. Okay, so there is a market for people just to trade the index. Now, you would think that when people are trading the index, it should just be the sum total, the arithmetic total of all the components, right? That's what they should be, because they are the same thing. In the end, they are the same thing. If these are CDSs for 5 year, so it's 5 year credit protection. So these are indices also for 5 years. Okay, so it is the exact representation of the risk in the CDSs. The funny thing is, sometimes there can be a difference of, let's say, 5 to 10 basis points. Not really a lot. Okay, sometimes there's a difference. And here is an opportunity for you to trade. So if the indices are paying higher, all right, then you just buy the index. You buy the index, and you sell all the individual CDSs. You package it up. You wait 5 years, and your money is free. That's the concept, okay? Now, the problem here, there are two problems. The problem is that difference is normally very small. So if it's 5 basis points and you leverage it, let's say 40 times. What's 5 basis points times 40? 200 basis points. That's still only 2%. Okay, but it seems that, so that's problem number one. Okay, it's normally very small. You might even wonder, why does it happen? Okay, well, it happens for the same reason that a lot of these so-called arbitrages, they're not really arbitrage. I think, well, I mean, it is, but the reason is that there is a market for CDS, there is a market for these indices or index trading, and the people who are in the CDS market and the people who are in the index market may not be the same people, okay? They may be, sometimes they're not. There are people who are trading both, and then it is precisely for this reason that you need people to arbitrage, because the arbitrageurs will cross over both markets. But if they are not the same people and they have different needs, they have different demands, different purposes for going into these markets, then yes, temporarily things can actually go out of equilibrium. Okay, so that's the reason. Now the problem is you have to leverage it, and what I remember, one of you asked a question I overheard. Okay, this looks like, you know, it's so simple. Why don't we leverage 4,000 times? Why 40? Why stop at 40? Okay, the problem is always, if today the gap was 5, and if tomorrow the gap was 7, okay, then at least on a mark-to-market, on a valuation basis, you now have a 2 basis point loss magnified 40 times. And if you have a 5-year trade, you don't multiply by 5, but the modified duration could be 4. Now, okay, let's just say 1 basis point. Okay, so that is the PV01. What is that? That is 160 basis points. So that's 1.6%. Okay. So if it moves 10 basis points, you lose 16%, which is actually quite a lot for something that you call an arbitrage. Arbitrage is supposed to be risk-free. Okay, that I think is the problem. It's not the, so you are here at par, you think you're going to be back at par, and most likely you will be. It's the journey you take. That's the part we worry about. Okay, and that is why it isn't so simple as just saying, oh, it's just an arbitrage. You buy a basket, you sell the components. There's no risk. Let's leverage 4,000 times. You can't do that. Okay, are you with me there? Are you okay with that? And this philosophical argument that you long one thing and you are short another and they look the same. This philosophical argument that you may suffer from mark-to-market swings, I think is applicable to all the arbitrages. If you know, there was a case back in the 1990s called LTCM, Long-Term Capital Management. It's a very famous, high-profile, spectacular default. It was precisely that. And that company was a hedge fund run by, some very capable people, including Nobel Prize winners. It's mainly mark-to-market that really hurt them. Okay. I think I will. So here are some actual examples of indices that you can trade. So you can see on the, I don't know if you can read that on the left-hand side. So European sovereigns, European senior, European subordinated financials, Corporation CE EMEA probably stands for Central Europe. EMEA is, what's that? Europe, Middle East, and Africa, I think. Or iTraxx Australia, Japan, okay? So lots of indices that you actually can take a position on. And then there are also, there are banks making markets on these quite actively sometimes, okay? And these are the individual actual CDSs of individual companies. Some of these are not so well known. And then there are the bids and the offer prices for the credit swap levels. Okay. So where's the arbitrage? Well, I already told you where the arbitrage is. Okay. And you can really you can jack it up like 40, 50 times. And then the idea is okay until you start to increase your leverage, and then you get into problems, okay? Okay, I think I will stop there, and I'm going to give you guys and we'll talk about the correlation risk and those, what are they called? Synthetic CDOs, maybe next time, okay? If you have not signed in yet, here's your chance to do so. Not this. So let me just stop this. So thank you everyone for coming.